Well, greetings and welcome to another edition of the UNL Center for Agricultural Profitability's webinar series. And we have the privilege today of talking with Dr. Alejandro Plastina from the University of Missouri and the Rural and Farm Finance Policy Analysis Center at Missouri to discuss the farm income outlook. We're going to discuss both the U.S. and the Nebraska farm income outlook based on some analysis and data just published through a collaborative agreement between RAF, the Rural and Farm Finance Policy Analysis Center, and the Nebraska Center for Agricultural Profitability. This is part of our ongoing webinar series that we do with the Center for Ag Profitability on a weekly basis. You can find information about past webinars on our website, cap.unl.edu/webinars. You'll find actually information there both on our past webinars and archived versions, as well as our future webinars and registration information about those. Today is an opportunity to talk about the farm income outlook as we have geared up here for the planting season and the beginning of the growing season here for the commodities here in the country. We're also looking ahead to the current outlook situation, and the farm income picture is a little bit muddled, or at least complex and interesting. We have an opportunity today to talk about that. As I said, Dr. Alejandro Plastina, who's actually a University of Nebraska grad. So welcome back to the Nebraska fold here for the day anyway, Alejandro. But an opportunity to talk about the farm income outlook and the drivers behind that. We're going to start with Alejandro and a discussion of the national scene before we spend some time talking about Nebraska numbers and then focus on some questions. If you have questions anytime, please use the Q&A panel to add your questions, and we'll address those as we can and at the end of the presentation as well. So Alejandro, I'll invite you to share your screen. There you go. I see your slides up and running, and we welcome you to the presentation here.
All right. Thank you very much, Brad. Can you hear me okay? Okay,
Sounds great. Yes.
So thank you very much for this opportunity to discuss with you the economic insights on U.S. farm income projections. And I will be, if I can slide it, I will be discussing the recent work that was published in collaboration with the University of Nebraska-Lincoln and the Center for Ag Profitability through the Rural and Farm Finance Policy Analysis Center. But before, let me say a few words about RAF. So we are a policy analysis center in the Division of Applied Social Sciences at the University of Missouri-Columbia, and this work is funded by U.S. Congress. Our goal is to provide unbiased analysis to policymakers to help them understand how federal policies, regional policies impact different states and regions differently. And the focus of our work is coordinated with USDA Office of the Chief Economist. So we are glad to share with our stakeholders not just policy briefs that are targeting policymakers mostly, but also relevant information on how the farm income across different states is expected to move, as well as a number of decision tools like, for example, ARC and PLC Payments Explorer or the Farm Earnings Explorer, where people can go and get insights by interacting with these online tools. And our website is www.rafmissouri.edu. So with that, let's go to the summary of my presentation today. And the bottom line is that we expect short and medium-term pain for field crops because of lower prices and some costs that remain high. On the cattle sector, things are in better shape. There's limited supply, high prices, and overall lower feed costs than in recent years. But the star of today's presentation will be the big one-time direct government payments that we expect in 2025. That would be sufficient to actually bring total net farm income up in this year. And that triggers the question of what will happen next year. So the policy outlook right now is very uncertain. As you know, we are waiting on definitions in terms of tariffs, trade, the discussion of the next farm bill whenever that happens, and any other programs, government programs that might or might not be put in place in 2026. So let's start by analyzing the largest commodities, and we'll look at corn first. Here in this chart, we have a summary of demand and supply at the top, demand at the bottom, and it has a combination of information from USDA reports, in particular the WASDE reports, and the latest FAPRI projections, both from April 2025, and it shows a trend between 2022 and the projected 2025 season, right? And when comparing numbers for 2024, 2025, USDA and FAPRI numbers are very close. What is most important for today's discussion is the 2025, the last column, right? Area planted, projected area planted for corn is expected to increase with respect to last year, with higher yields resulting in a larger production. That's a very large crop. Unfortunately, the demand side is also expected to increase, and we have higher feed use, higher ethanol and other domestic uses, and exports are also expected to go up in 2025. But the increase in demand, although it's substantial, it's not enough to absorb all the extra production. So ending stocks are expected to go up. And with that, there will be a downward pressure on prices. So a reduced profitability on the corn side could be expected for this year. Now, looking at wheat, same sources of information, same structure. We have supply at the top, demand at the bottom. And while area planted remains pretty much stable, a lower, more normal yield is expected for the US, so production would go down slightly, but at the same time, the demand side will go down slightly according to projections, mostly driven by lower exports and to a lower extent, lower feed and residual use. Now, with increasing ending stocks, the market in year average price for wheat expected to decline slightly from 554 to 550. So again, lower revenues on the wheat side. But if we expand our analysis to look at what the market is saying beyond what FAPRI is projecting and what the Economic Research Service projected back in February of 2025, that's the black line in both charts here, we see that for corn prices, both FAPRI and the Economic Research Service project lower corn prices for all the way to 2029 with respect to prices in 2024, right? So there's a decline and then a slight increase, but not much of an increase at all. And when we look at futures prices, at least from 2 days ago, this is settlement prices from April 29th. The market was pricing corn futures, December's future, a little bit higher in 2026 than in 2025, and then slightly declining for the next 2 years. But again, these are not terribly high prices, much lower than what we've seen recently. Similar pattern on the wheat side, but the futures market for wheat, at least 2 days ago, was pricing an increase in wheat prices from 2025 to 2027. Again, not substantial to bring prices back to the 2022 levels. The other major crop is particularly for for Nebraska is soybeans. And in this case, by the time these projections were made, the price ratio between corn and soybeans favored corn. So that increase in corn area is impacting the soybean area negatively, of course. So we have fewer planted acres in this projection for 2025, more higher yields, and with that, a higher production. So higher yields are expected to offset the decline in a planted area. So even with lower acreage, we have a larger crop, and unfortunately, the demand side is not expanding as fast as the production side, and the ending stocks are expected to go up, and with that, bring prices down to close to $10 per bushel. It's important to note that these projections were published by Fabry in early April, but they were based on information that was available in January and February of 2025. So these projections do not include the impact or potential impact of tariffs, and the impact of tariffs and the potential trade disputes, right, that might arise if the 145% tariffs on Chinese products are not resolved in the next couple of months. So be careful, be mindful when reading these numbers, because they don't incorporate any impact of tariffs on trade after February 2025. So if trade is affected and exports are lower, then ending stocks might end up being larger than projected in this slide, and that would put further downward pressure on prices. But when we look at futures prices in green there for the November futures contract, those follow pretty closely what both Fabry and the Economic Research Service projected for the next few years. And that's, stable to lower prices. So with that, we couldn't expect a major improvement in soybean profitability in the coming years. So in this graph, we are moving from the season of the crop year into calendar years, and these calculations entail incorporating information on how much of the old crop is marketed in the following year, right? And how much of the new crop is marketed in any given year. So except for other crops, which are mostly fruits and vegetables, all other crops in this graph are expected to see a decrease in cash receipts from 2024 to 2025. So in general, we can expect lower cash receipts for crops in the Midwest. On the other side of the equation, cost of production is not really coming down as fast as prices. Although we've seen a substantial decrease in variable costs from 2022 to 2023, particularly in fertilizer costs, seed costs and other costs are stubbornly high or stable, and that affects, of course, the profitability of these crops with lower prices and slightly lower but still high costs, right? We're seeing increases in labor costs. We're seeing increases in rents, and that affects, of course, the profitability of rented acres. But labor costs affect all producers. So the margins are becoming thinner and thinner, and in some cases might even be negative for some farmers. When we look at the production costs over a longer term, those costs, again, are expected to go down in 2025 with respect to 2024 slightly, but not by much and not for long, because if we look at 2026 through 2029, those costs are actually trending up instead of down, which is bad news for crop producers, of course. So with that, it's pretty clear that the profit margins on crop production are getting squeezed, and some of them might be negative in 2025. When we look at cattle and other livestock, in general, those cash receipts are, as an aggregate, going up. And in this graph, all lines, poultry, eggs, dairy products, hogs, and cattle, they are all going up. So that's good news for livestock, the livestock sector. Now, for how long can we expect those prices to go up? Well, livestock, particularly cattle prices, tend to move with the herd expansion and contraction. And this long-term graph shows that the contraction of the cow herd might last until 2026. And with that, we could expect prices to remain supported by this short supply until 2026 or 2027. But after that, a recomposition of the cow herd might soften prices. And that's what we see in this graph. The fed steer prices received by farmers selling fed steers, that's the yellow line at the bottom, or the gold line at the bottom, would continue to go up until 2027. And after that, they would decline. But that's good news for cattle producers. But on the other side of this graph, where we have the black line, and that's going up even faster. And that's the price of feeder steers. So that's the input of production of livestock, right? Of fed steers. So costs for cattle producers are going up faster than received prices. So the good news is that feed costs are going down. So depending on the equation on purchased livestock expenses versus feed expenses, margins could continue to be healthy for 1, 2, or 3 years. But clearly, margins are getting thinner and thinner over time, but still remaining healthy for a couple of years. Now, as I said at the beginning, the star of this presentation will be direct government payments. And that gray portion of the bar for 2025 is showing the supplemental and ad hoc disaster assistance payments projected for calendar year 2025. And you can see that portion of the bar is larger than the gray portion of the bar in 2020 with the MFP and other programs back then. And of course, that tremendous influx of liquidity into the ag sector would bring net farm income up, and substantially. One of the major programs that we know of right now is the Emergency Commodity Assistance Program that will be distributed across multiple commodities and the entire nation. where Nebraska would capture about 7% of those payments up to, these are $10 billion in ECAP payments. So that's a lot of revenue flowing into each of these states in the graph. So with that increase in direct government payments, the USDA is projecting a 30% increase in net farm income and slightly lower, a 22% increase in net cash farm income for 2025, which both measures of income are much higher than their long-term average at this point. So that's good news. Excuse me. That's good news for the ag sector. Their net farm income is going up. There's liquidity. Hopefully, there's profitability, and farmers can support their operations. Farmers and ranchers can support their operations in 2025 with this extra liquidity. The concerning part of this spike is the drop that could happen in 2026 if no other source of payments is activated going into 2026. And that's what FAPRI and RAF actually expect, that currently there's no indication that another major set of ad hoc one-time programs will come online in 2026. And that, of course, will bring us back to the downward trend in profit margins in the ag sector. And that's concerning because, as I said, those government payments will not be there. Here's what FAPRI is projecting in terms of major programs going back to zero after 2025. These ad hoc disaster payments will disappear, and we will be able to use ARC and PLC, but those won't trigger such large payments as the ad hoc programs. So let's look at how much these different components contribute to net farm income in 2025 and compare that to the previous year. So farm receipts in 2024 decreased by $1.8 billion. Total expenses decreased by $9 billion. So that comparing those two, there was an increase of about $7 billion, $7.2 billion in net farm income, and government payments contributed an additional $2.9 billion. Sorry, there was a decrease in government payments of $2.9 billion. So the total decrease in net farm income was $8.2 billion in 2024. Now, going into 2025, farm receipts are projected to go down by $0.8 billion. Total expenses would go down by $0.7 billion. So there's a $0.1 billion decrease there net. But government payments are actually increasing net farm income by $33 billion. So that's what these government payments really mean for agriculture. That's a tremendous influx of revenue, of liquidity, and the net farm income would go up by $40.6 billion, again, mostly driven by government payments. If those programs, those ad hoc programs, dry up in 2026, then as expected, I should say, as expected, the net farm income will go down to the long-term declining trajectory, and that's what's concerning. So we have to keep an eye on what's happening around agriculture, what's happening around agricultural prices and policies that affect this net farm income outlook. For example, the uncertainty from trade effects that are likely to affect agricultural exports. Right now, on the left, you can see the major importers of U.S. agricultural exports, so where U.S. products are going. And those countries highlighted in the graph are those that are currently evaluating changes in their tariff structure based on tariff discussions with the US. Now, the question is whether the trade effects will resemble to some extent what happened in 2018, 2019, 2020, and whether there will be a market facilitation program or another kind of program to supplement the loss in revenue, in export revenue that was provided during 2019, 2020. And if that will happen in 2026 or later. So the timing and the magnitude of any new program will be critical for agriculture. And also there's uncertainty on the input side of things because, as you know, most of the potash, for example, is imported, and most of the imported potash is coming from Canada. So right now, there's a pause in these high tariffs, but we can go, and potash and energy have a 10% tariff with Canada, but we don't know what will happen, whether higher tariffs will be implemented or not. And we have to be careful about how tariffs will impact not only the destination of our exports, but also the cost of our inputs, of our imported inputs, I should say. So other variables that we need to keep track of are interest rates, whether there will be a cut in interest rates or not this year or next year will result in lower or not lower input costs. What will happen with fertilizers, other chemicals, and seed costs. Seed costs have been pretty stable over time. And then whether the current safety net programs will be redesigned or changed in any way, particularly ARC and PLC, and if there are going to be any new programs going into the Farm Bill or not, and when that will happen. Those are uncertain issues at this point. And then how biofuel policies can affect production, particularly for soybeans, corn, and the 45Z tax credits and so on that are currently being revised. So lots of uncertainty, much more uncertainty than in previous years this year. But 2025, again, seems like a year where farmers or the ag sector as a whole could accumulate some cash reserves, some liquidity, and I think it will be critical for the ag sector to plan ahead and use those cash reserves smartly and prepare for a much less profitable 2026. So with that, I will stop and share this QR code if you would like to sign up for RAF updates in your inbox.
Alejandro, thank you very much. Before we transition to sort of the parallel outlook here in Nebraska, which will mimic much of the information you shared nationally, we do have a couple questions that are
Sure.
pretty directly applicable to some of the work and the assumptions you make in there. The first one actually that came up is back when you're talking about crop production numbers and particularly acreage estimates. There's been a lot of debate this spring about corn versus soybean acreage. But recognize that, explain again when your projections come out in the FAP report, they sort of reflect the consensus or the thinking as of what time period, and compare that to USDA's baseline that is published in February, and then finally the prospective plantings report that came out from USDA at the end of March. So
Yes.
how do those reconcile, or how do they compare, maybe more specifically?
Yeah, that's a great question. And as I said, the timing of these reports is critical to understand what numbers we're discussing. So the baseline projections came out on February 6th. FAPRI projections came out the first week of April, but they incorporate information up until the end of January, early February. So the baseline, the USDA baseline and the FAPRI projections are very similar. And of course, they were finalized before the prospective planting report came out. So they are different. And the planting reports is much more optimistic in corn area than what FAPRI and the baseline have. And higher corn area is taken out of production area on mostly on soybeans in the Midwest. But those numbers are not showing, the prospective planting report numbers are not showing in this set of slides that I shared with the audience. However, the RAF report, the information that you will present, incorporates information on the prospective plantings. So the corn, soybean, wheat, and so on, acreage is based on the latest data from ERS, which are the prospective planting reports. So there's a slight disconnection, but the overall trend is very similar. It's applicable. This national projection, this national outlook provides, I think, a reasonable backdrop for the state level projections that are more updated than this set of national projections that I shared with the audience.
Yeah. And it's fair to say, when we look forward to doing this again in the fall, probably none of those numbers will be exactly right.
That's completely true. And I agree. Unfortunately, I have to agree with that. There will be, yield discrepancies. There will be harvested area differences.
Yes.
And yes, we should have a better estimate for 2025 than what we have today.
And I think even the speed of planting progress tends to affect that corn soybean balance too. So so we'll see how that plays out here. So lots of things obviously that we can't predict. They are the shocks and the sort of unexpected random elements that'll play out every time. There was another question about the supplemental payments, and I think more appropriate, or more specifically, the outlook, the FAPRI outlook, and our Nebraska outlook, the RAF Nebraska projections as well. Neither of them fully presume trade losses and damage from ongoing trade conflict, but neither of them also presume any trade assistance payments. So we're sitting with an outlook knowing that there's great uncertainty on the trade side in terms of potential financial losses, but also in terms of potential assistance down the road.
Correct. Yes, that's not included in these projections, nor the FAPRI projections, not the USDA projections, and not the Nebraska RAF projections.
Yeah.
Correct.
So it gives you a perspective. It's a picture of what we see ahead, but it's also a baseline, sort of barring shocks and every announcement that has not officially yet happened. So more information to digest as we go along. Okay.
Correct. Yes.
Alejandro, I'll let you sit aside for the moment here, and I'll share a presentation of the Nebraska outlook. My discussion of what's going on in Nebraska and the outlook really for 24 and 25 as we confirm some numbers for 24 and look ahead. The outlook is that the picture in Nebraska really does mimic the national picture, but it does move slightly differently and for some specific reasons. The key drivers here, just like nationally, that Alejandro talked about, are particularly crop and livestock prices, sticky production costs, some sort of dramatic upheaval in the farm income safety net in terms of what's in the traditional safety net versus what's in the what's coming via ad hoc assistance. And then, of course, the management questions that we're going to have to deal with here to manage through the coming year. If you look at that into the next slide, you're going to see a farm income projection here in Nebraska that is at a record level, 9.5, get my number here, 9.4 billion here for 2025 will be a record number. And it's kind of hard to explain a record farm income in Nebraska when we also hear headlines and concerns of financial challenges and tightening margins and a difficult road ahead. But if you just look back a few years, we set a record farm income in 2021. We were projected to go forward for a record in 2022, except that we ran into the drought. And while the United States set a record farm income in 2022, Nebraska fell back. We rebounded dramatically in 23 and did, in fact, set a record. And then we fell sharply in 24 before rising sharply in 25 as projected, only to sort of bring us back on par with where we were 2 years ago. So it's not so much that we've set a record farm income, it's that the last 5 years look like a roller coaster. And it's been really difficult to sort of have any confidence in where the picture it really is and what direction we're really moving. And in fact, the 2025 numbers in Nebraska will sort of mimic the same question we have nationally in 2025, which is if you look to the market, net farm income is struggling nationally, and it shows a little bit more strength here in Nebraska, particularly because of the cattle sector. But it's really the government payments, the ad hoc assistance, that are bumping up the farm income projections the most. And so let's dig into those just a bit deeper. The next slide actually will show us the same net farm income numbers, but on a real adjusted basis. So it's worth noting that even though we are dealing with the uncertainty and the volatility of farm income projections over the last 5 years, we're actually doing so at relatively strong farm income levels, even on real terms. We're above the roughly 55-year average. We are above a 10-year average if I plug that one in there as well. And even though we're concerned about margins and financial outlook, we're doing so, or at least looking at that from a relatively strong base here. Now, if you move forward a slide, however, it begins to tell some of the stories and the challenges. The farm income outlook in Nebraska is almost like a tale of two farms, or more specifically, maybe a tale of a farm and a ranch. Because while the livestock side shows stronger receipts into 2025 for projections, the crop side has been dealing with lower and lower receipts over the last 3 years. It really is a difference of livestock versus crops. And even in livestock, it's really cattle plus everything else versus crops. Cattle are driving the livestock receipts higher. They're 80+% of livestock receipts in Nebraska. And it's livestock as a whole that are driving the farm income numbers stronger for this year. So there really is a different outlook, or at least the feeling of a different outlook based on the different sectors here in Nebraska. The next slide digs into some of the challenges that we see, however, with costs. While farm income looks higher, but it's a difference of livestock versus crop sector, the costs just keep moving higher and higher. And when you see those costs that are peaking out at record or near record levels here again, even as we see concerns about declining commodity prices on the crop sector, we don't see, and at least fear, that that costs are not falling back in turn. Now dig into those costs just a little bit deeper, however, and the biggest single chunk you see there is intermediate product expenses. Move to the next slide, and there's a little more detail on that. If you look at USDA's farm income projections, they have what they call intermediate product expenses that fundamentally cover farm origin inputs as well as manufactured inputs as well as other inputs. And then you have labor, interest, and other overheads sort of show up in different categories. But on that sort of intermediate product expenses, think generally purchased inputs. Farm origin is the one that has clearly grown leaps and bounds faster than the rest. Manufactured inputs are higher, other inputs are higher, but farm inputs are the highest. Now, clarify, farm inputs are purchased livestock, purchased feed, purchased seed. Seed counts as a farm origin input because seed production does start on the farm and does contribute to farm income there as well. But the same things that have driven livestock prices higher and driven crop prices higher in some previous years also drive the input costs because they're driving feeder cattle purchases, they're driving feed purchases higher as well. So some of this is costs go up because incomes go up, and costs follow incomes up. Costs maybe don't follow drops in income nearly as quickly. And that's some of the concern we have about the sector here in Nebraska. The next slide. Thank you, Ryan. The other big story we have, a difference of a livestock versus a crop sector, concerns over cost, and then it's this uncertainty of government payments. This is looking at the sort of entirety of the farm program payment portfolio, except for crop insurance. Crop insurance is another important part of the safety net and substantial federal support, but that's not paid directly from the government to the producer, so it doesn't show up in their statistics the same way. If you look at these payments from the government to producers, we have near record levels of projected payments here in 2025, second only to the COVID highs of 2020. Nationally, that number would even show that 2025 projected payments are higher than the heights of the COVID era payments in 2020. In Nebraska, not quite as much based on our projections. But it fundamentally does point to some of the challenges of projecting income and projecting your financial position because this assistance, this supplemental assistance, tends to happen after the fact, and it tends to happen with some uncertainty about when and how it might help out. If you look back in those projections, go back far enough, 25 years or more, you see those supplemental payments showing up in 1999 and 2000 and 2001 and 2002. That was a big bump at the time. That was supplemental payments that helped make up for declining commodity prices amid some losses of Southeast Asian export demand. Those declining prices, those declining economics were met with supplemental payments that helped lead into a farm bill debate in 2002. Then come more recently in the last decade, and you see supplemental payments again show up big in 2018 and 2019. That was the first Trump administration and the trade conflict going on that translated into market facilitation program payments. By 2020, you add in COVID assistance payments and various forms of COVID era relief or supplemental payments, and we set record levels of payments and record levels of payments contributing to farm income. Those have weaned off or waned over time, but here we are again in 2025, looking at estimates of supplemental payments in the form of the Emergency Crop Assistance Program, and Alejandro pointed to that program, 10 billion nationwide, might be 620 plus million here in Nebraska, and the Ag Disaster Assistance, which is estimated at 21 billion nationwide, but details yet to be determined, so uncertainty in terms of what it may actually bring here to Nebraska. That's the reality. We have relatively strong numbers and farm income projections, but they're also built on some payments that we don't necessarily have much certainty or confidence about looking forward. Ryan, the next slide, please. If you sum up all of those changes, you get from 2024 to 2025, and you get a dramatic increase in farm income from around a $6 billion number to a $9.4 billion farm income number for Nebraska. Much of that comes from government payments. There's also a big box there for positive changes in all other categories. That's predominantly an inventory adjustment, is most of that change. And inventory adjustments can be a little bit sort of fuzzy from year to year, but a larger crop translates into a larger projected inventory at current prices, and you have some adjustments to make. Livestock inventories that continue getting more valuable with higher prices, that helps out those numbers. But it is fundamentally a story of going from a $6 billion number in 2024, which is technically still an estimate. It's not an official number until USDA publishes some numbers here in August that will officially estimate past years. But to go from 6 billion to 9 billion amid a time when we're also still concerned about the outlook is a rather dramatic shift here in Nebraska. Now, the look ahead, if we move another slide, this $9.4 billion record falls back dramatically in 2026 based on current projections. So here we are, we're still riding the same roller coaster up and down. Continued weakness in the crop sector might be buoyed a little bit by crop receipts in the next calendar year. Livestock receipts still look higher as cattle prices still work through smaller supplies, but input costs, a return to fewer or at least less projected crop insurance indemnity payments, a return to lower projected government payments, and we end up dropping from about a 9.4 billion number to about a $7.8 billion number. It would still be strong by any sort of historical measure, but a sharp drop projected in the next calendar year. The next slide, Ryan. So if you tried to carry that out, if we do in fact set a record here in 2025, we expect a sharp drop into the next year, 2026. Over that longer run of the next decade, perhaps we sort of vacillate a little bit back and forth, but eventually we might move towards a baseline that now projects us somewhere in the $8 billion to $8.5 billion farm income range. That would be a substantial, stronger plateau than we had been in the last decade. But of course, that remains to be seen with lots of uncertainty ahead. So another slide there, Ryan. Now, to sum that up in a little bit of a tongue-in-cheek way, our current projection looks relatively strong, but we fear all the uncertainties ahead. We fear uncertainties on the crop and livestock sector, particularly with uncertainties about trade and trade conflict. We're concerned about input costs. We're unsure about future government program support. The level of uncertainty is as great perhaps as it's ever been. And lo and behold, leave it to economists to find a way to measure the things we don't even know. That is to measure uncertainty. There's an index being published that measures uncertainty as a function of uncertainty in the headlines, uncertainty about tax policy, uncertainty about economic projections. And by those calculations, uncertainty is at the highest level it's been here in the United States for economic policy, as high as it was in the midst of the COVID era pandemic in 2020. That's how challenging this outlook really is at the present time. So we have a number that looks really strong in Nebraska for 2025. We have lots of concerns or questions on the horizon. And Ryan, one more slide there, please. It leaves us looking ahead and saying, we've still got issues to manage. We have to work through the situation. Much as Alejandro described, we have questions about managing lower crop prices, even as livestock receipts help sort of buoy the overall sector. We have concerns about the role of the safety net, and as we debate a new farm bill eventually, or when and if a new farm bill will come, what will the safety net actually look like, and will it provide more support? But over the last few years, the ad hoc assistance has overwhelmed the fundamental role of the underlying safety net. And so we have uncertainty there. It leaves us trying to figure out what to decisions to make on the management side, and that's managing production expenses that tend to remain sticky at near record high levels. It's focusing more on profit margins than it is on yields or prices or revenue as a whole. And it's managing through the uncertainty that we have at the present time. The outlook is still difficult, even if we're talking about a record farm income projection in Nebraska for 2025. That's where I'll leave the presentation. Ryan, thank you for managing that. I'll let you stop sharing, and then we can go back to more Q&A. And Alejandro, I'll invite you back to join and unmute. So Alejandro provided some more information in the chat box relative to the American Relief Act. That's the 31 billion in assistance, 10 billion for what has become the emergency crop assistance program, and roughly 21 billion for disaster assistance. I don't expect Nebraska to get a substantial share of that 21 billion, as at least my interpretation or my thoughts were that a substantial portion of that 21 billion really was targeted at the hurricane losses in the Southeast and the damage there. But even a smaller share of that 21 billion could add several hundred million more. And that's what leads to our farm program payment projections of around 1.6 million or 1.6 billion in Nebraska for 2025. As we're closing in, again, I invite more questions. Just a couple of housekeeping notes, however, as one of the questions asked. Yes, these webinar slides will be available. This webinar is being recorded. It will be posted up on our Center for Ag Profitability website, and the slides will be posted along with it when they're available here. I don't see any additional questions at the present time. We're closing in on our 1 hour target here. But Alejandro, I'd invite you back into the discussion. As you saw the numbers as you were developing them, Nebraska looks like the national numbers, but not exactly in sync. What does that, what do you see ahead for Nebraska from your perspective?
So I think you painted a very clear picture about the uncertainty that that we are seeing behind these projections, and for each state, the mix of crop and livestock really makes a huge difference in terms of how much ad hoc payments they could receive in 2025, and also how much of a profit margin each state can maintain in 2025 and 2026, as we see livestock being profitable and crops not so much. So those are the two major drivers at this point of the differences in forecasts or projections for the 10 states that we cover.
Yeah. So prospects really may vary more by sector, and the Nebraska's strength in the cattle sector really helps
Exactly.
drive our farm income prospects.
Correct. Yes.
Okay.
Yeah. Other states with a larger portion of crops on their cash receipts won't see such a large increase in net farm income.
Yeah. We actually saw an increase in net farm income even prior to the large bump up we saw in government payments. I suspect in other states, it's the bump in government payments that makes the difference between the higher or lower farm income.
Yes. For example, in Missouri, all of the increase is coming from government payments.
Yeah. Yeah. Okay, we do have one question. We'll make this the final question as time approaches, but it's a really big philosophical question, Alejandro. Um, with the economic conditions we have, with the projections and uncertainty that are ahead, what does it fundamentally mean for the farm sector as a whole in terms of farm numbers and consolidation and growth?
Hmm. So I think just continuing the long-term trend of consolidation in the ag sector, I think that's the main answer. About the speed of the consolidation, I think we might see a pickup, a tick up on that speed coming 2026, as those who have already accumulated equity might be in a better position to continue producing over larger areas to keep costs
Hmm.
down, acquiring more land on the crop side mostly, right?
Yep.
So I think, yeah, consolidation, concentration would, I think, would continue its long-term trend, but maybe at an accelerated pace going forward, 2026, 2027, if things don't change.
It sort of suggests that it's hard to sort of change the economics of the long run trends, and the long run trends have been
Mhm.
towards more consolidation.
Yeah.
The current outlook and the uncertainty of the outlook creates the uncertainty and the disruptive forces that might only accelerate whatever trends are already occurring.
Yes,
Yeah.
I agree with that.
So, well, with that, Alejandro, thank you very much for your time, not just your
Thank
time
you very
today
much.
to help present the national picture, but fundamentally, it's Dr. Plastina's leadership that drives the Rural and Farm Finance Policy Analysis Center at the University of Missouri. And that's the collaboration that gives us an opportunity to bring the broader FAPRI picture of what's happening nationally in the ag sector down to a state by state perspective. And that gives us more insight on Nebraska to at least plan for what might be ahead, even knowing that sure enough, we'll be here again in 6 months talking about what changed. But it gives us the opportunity to provide a perspective on Nebraska that adds value and creates more understanding of where we're at. So with that, thank you very much, Alejandro.
Thank you very
Thank
much,
you
Brad.
to our participants today for joining in our webinar. Thank you for being part of the Center for Ag Profitability webinar series. If you, again, are looking for information on this webinar or any others, you can find archived versions of past webinars, and you can find a schedule of what's to come on our Center for Ag Profitability website. cap.unl.edu/webinars takes you to the webinar page. But we look forward to seeing you again at a coming webinar. I know we have a webinar planned next week to talk to the USDA Farm Service Agency state office here in Nebraska about programs and opportunities and work that they're going through as well. So the information continues to flow. We look forward to seeing you the next time around. Thank you.